Friends, welcome to the channel JIB and CIB Made Simple. In this session, we are going to discuss our unit number 1 theory portion of BRBL, and the chapter name, as you can see, is the legal framework of regulation of bank. So before delving into the chapter, let's see what are the topic which we are going to discuss. Introduction, business of banking, constitution of banks, Reserve Bank of India Act 1934. Just wait a minute. Yeah, now it is Reserve Bank of India Act 1934, Banking Regulation Act 1949. Then we have Reserve Bank as a central bank and regulator of NBFCs. Then we have 1.7 number topic, that is government as a regulator of bank, control over cooperative bank, and regulation of bank by other authority. So in this chapter we will cover 5 topic, and in the next video we will cover the 5 topic. So let's start with the part 1 lecture. Let's start with the introduction. So we are diving into an important topic, that the basics of regulation, banking regulation in India. Now you might think that this sound a bit boring, but trust me, it is super important and really interesting once you break it down. So let's start with the governing act that keep everything in check. So banking in India is mainly controlled by 2 acts. The first act is Banking Regulation Act 1949, and the second act, is the Reserve Bank of India Act 1934. Sounds a bit like legal jargon, right? But don't worry, I will explain. These 2 acts are like the rule book for how bank operate in India. So let me highlight it. These are like rule book for how bank operate in India. They tells bank what they can and what they cannot do, and help think fair and safe for you and me when we use banking service. Right, now let's talk about who controls the bank. Right, who controls the bank? Let's answer this question. Who controls? So friends, it is not just any random authority. The Reserve Bank of India and the Government of India are the one making sure everything running smoothly from the moment a bank is set up to when it may be closed down. Right, so that is called RBI and Government of India. They controls it. Now here is the twist. Not all bank are same. Some bank are statutory. Right, so not all bank are same. Some bank are statutory corporation, some banks are banking company, and some are cooperative society. You can see it written here. Some are statutory, some are banking company, and some are cooperative society. And guess what, each type has slightly different rule depending on what kind of bank is. So let's break down what is banking means, the different types of bank you encounter, and the role of RBI. So let's first of all we will understand what is the meaning of this term statutory, banking company, and cooperative society. Before that, let's understand what are the key functions and what is the definition of RBI and banking, and also discuss the key function. Right, so first of all, as per the section 5B of the BRA 1949, banking means accepting for the purpose of lending or investing. Like suppose this is the bank, so this they accept the deposit. For what they accept the deposit? They accept the deposit for lending or investing. Right, and they and what do bank do with this money? They give loan. Right, so let's look at the key function of banking. You must remember this section 5B of the Banking Regulation Act where it is defined. So the first function is that you might think you might use a bank every day, but have you ever wondered what they actually do behind the scene? So first thing they do is the acceptance of deposit from the public. Right, so when you deposit money into your bank account, the bank is basically holding onto in for it. That is their main job. They keep your money safe until you need it. Bank accept deposit from public, which is why we trust them with our saving. Now the question is, what do bank do with all this money? They don't just keep it all in vault. They lend or invest that money to other. Right, so that is called lending or investing of such deposit to other. So when you see a loan being given or an investment being made, you can be sure that your deposited money is working. Right, so these are the key functions. First of all, they accept the deposit and they lend it. Now let's talk about the deposit condition. What are the deposit condition? Let's discuss it now. Friend, deposit can either be on demand or after an agreed time. So it can be either refundable on demand or after an agreed time. Right, so you might get your money back right away or after a set period, like a fixed deposit. But one thing is clear, bank only accept money, no jewelry, no land, just good cash. Right, so that is only deposit of money are accepted. But here is the important part, bank don't accept everyone. There is an acceptance criteria. Right, bank don't accept everyone. If someone has a bad track record or is not trustworthy, a bank can refuse to open an account. Bank are careful about who they let in, so they make sure they know their customer before accepting any deposit. Right, that is called acceptance criteria. That is where your KYC this is called know your customer comes into picture. KYC guidelines. So friends, bank need to know who you are before letting you open an account. So this help them protect them from fraud. You can see this help them protect them from fraud, right? So this help them protect them from fraud and ensure that no one is using the bank for illegal activity like money laundering, like or funding terrorism. So when you go to open a new account, don't be surprised if they ask you for your ID. It is a part of process to keep things safe for everyone. So in a nutshell, we can say bank are not just place to store your money. They are safe, regulated space that makes sure everything run smoothly and securely. So I hope this makes sense to you. Now let's look at the key points on banking regulation in India. So friends, let's break down some key points on banking regulation in India, and trust me, it's going to be easier than you think. So let's first talk about the governing acts. I told you earlier that there are two acts, right? So that keeps the banking system in check in India. The first is called Banking Regulation Act and the second is called RBI Act 1934. Now I know these names are sound pretty legal and complex, but these acts are basically the rule book. So they lay down the foundation for how banks should operate, ensure fairness. So the question is who controls. I think there is a repeated part. This part gets repeated, right? So let me move forward. Yes. So let's talk about this deposit withdrawable by check. Key function we have covered. Now bank also have a specific rule for withdrawable deposit. Let's talk about it. Bank also have a specific rule for withdrawable deposit. According to the section number 49A, right, only certain institution like banking company, RBI, SBI or notified entity, they can accept deposit that are withdrawable by check. So only certain company as per section number 49A they can accept or they can accept deposit that are withdrawable by check. But don't worry, some government run saving bank scheme are an exemption of it, right? Saving bank scheme run by government are an exemption. They can also do that. And did you know that non-banking entities like NBFC, firms and other unincorporated association can also accept deposit. So this NBFC, firms and other unincorporated association, they can also accept deposit from the public, right? But they are regulated by the RBI and they are strict guideline. There are strict guidelines they must follow, right? Finally, here is the big one, licensing part. In India, only banking company that are licensed by RBI can use the word bank in their name. So this word bank, this word bank can be used by only those banking company which have taken license from the RBI, right? So they under section number 22. So if you see an institution calling itself a bank but does not have an RBI license, it is a big red flag. Some society and association might be exempted from this rule, but it is important to know who is regulated and who is not, right? So there you have it. Bank have a strict rule for deposit, withdrawal and who they do business with. Understanding this key function help you see how bank protect your money and make sure everything runs smoothly. Now let's talk about permitted and prohibited business under the Banking Regulation Act. Very important part. So friends, are you ready to get a clear understanding of what bank can and cannot do under the Banking Regulation Act? So in this slide, we are diving into some of the key permitted and prohibited activity. First, let's talk about the permitted business. So these are the activity that banks are allowed to engage in. So you can see the first thing they can do is the acceptance of deposit and lending. This is the bread and butter of banking, right? Bank can accept deposit from you and lend that money out to other or invest it. Then dealing in the bill of exchange, which we call BOE, bill of exchange. That bank can buy, sell and trade financial document like bill of exchange. Think of it, bill of exchange is just like a promise to pay, right? Bill of exchange is just like a promise to pay, right? So this is the second function, permitted business. The third permitted business is managing, selling and realizing property. You can see written here, managing, selling and realizing property possession. So if a bank has a property because someone has not paid back a loan, so for example a house or car, so they can sell or manage that property to recover the money, right? And also there is a transaction guarantee and indemnity business, which means that this just means that bank can act like a guarantor. They can promise to pay someone else debt if they can't, right? So this is called, and also they can lend with or without security. Whether you have collateral or not, bank can lend you money. So we have discussed they can accept deposit, they deal in the bill of exchange, they are also lending, they are also lending with or without security, and transacting guarantee and indemnity business. These are the key functions of bank. Now let's look at the prohibited business. So key business, permissible business we have looked at. Let's look at the prohibited business. What are the prohibited business? So things bank cannot do. The first thing they cannot do is a trading activity, which means bank are not allowed to get into business of buying and selling goods. They can't take on the risk of trading, like running a grocery store or dealing in cloth, right? So that's called trading activity. They can't do and undertake the trading activity, right? The second thing is they can't do is buying, selling or goods. So basically no bartering, no trading in product for profit. So here is a one exemption. Exemption is that if the bank has taken something as security for a loan, right? If the bank has taken something as security for loan, right? Like for house, for a mortgage, so they can sell that property to recover their money. So this is an exception. You must remember that suppose you have taken a home loan and you have given your house as a mortgage and you are unable to pay that particular money to the bank. So the bank can sell your loan to recover the money. That is the point. Now here is a really interesting point. Bank are allowed to get involved with bill of exchange. I told you earlier, right? Bank are allowed to get involved with the bill of exchange or things like administration of estate. You can see this word written here, or things like, you know, bills of exchange, administration of estate, right? So what does it mean? It means that if someone dies, the bank can help manage the estate as an executor. Another cool thing is that immovable property. You see this word, immovable property, like land and building. So bank can hold on property for up to 7 years. If they need to sell it earlier, they can. If they need more time, the RBI can grant them extension of 5 more years to help protect depositor interest, right? So holding period for immovable property, a standard holding period is 7 years, but they can get 5-year extension more. So in a nutshell, we can say that a bank has lot of restriction on what they can do, like and these rules are designed to keep everything safe and secure for customer like you and me, right? So prohibited business, you can see they are not allowed to do undertake buying and selling. Trading activity they can't do, exception for relation of security, right? And they allowed activity in connection with bill of exchange. Now let's discuss the next point, that we have constitution of bank in India, right? You can see constitution of bank in India, super important points. So friends, in this slide we are diving into the constitution of bank in India. Sounds technical, but trust me, it is a way more interesting than it sounds. You know, first thing is that bank in India can be categorized into different types based on their constitution or their formation. There are 3 main categories. The first is called body corporate. What is the meaning of body corporate? You know, these are the banks that are created by a special law or statute. So you can see special statute, or we call it a special law. So these are set up by special law or statute. Think of them as a special purpose bank created to handle a specific need, right? That is called body corporate. Then we have company. You know what is the meaning of company? Most banks are formed as company under the Companies Act of 1956 or 2013, right? So and guess what? Foreign bank also fall into this category because they are formed outside India but operate here according to the Indian law. So you must know that foreign banks are also included under the companies, although they are formed outside India, but they are also included in this law. They fall into this category, company. The third, we have corporate society. So cooperative society means what? These banks are set up on a cooperative basis and are registered under a specific central or state law, right? So they are like community based bank working for mutual benefit. So body corporate, you know, I hope the difference is clear. Body corporate are the bank that are created by a special law, a special statute, right? Company means bank form as a company under the Companies Act 2013, right? And foreign bank are also part of this company. And third is a cooperative bank. Now let's first discuss public sector bank. So these are the bank that were nationalized. You know, they were nationalized by the central government. So this means the government owns this bank now, and the rules around them are governed by the banking company. What is the rule? Rule are governed by banking company, acquisition and transfer of undertaking act 1970 or 1980. So when you see big name like Bank of Baroda, Punjab National Bank, Bank of India, you know, they are part of the public sector bank. Now SBI is a special case. Why SBI is a special case? Because you know, it was created under the SBI Act 1955. SBI was created under the SBI Act 1955. You must know it, and you know that it is a big daddy of Indian banking. And did you know why? That it used to have 7 subsidiary bank. It used to have 7 subsidiary bank, right? But they all merged with SBI in financial year 2017-2018. So now it is one big powerful bank. Then we have something called RRB. Right, then we have something called RRB. RRB is called Regional Rural Bank. You know, these banks are set up under the RRB Act 1976. First fact you must know, RRB Act 1976, under this was set up, and their job is to focus on rural area. As the name itself suggests, they are regional rural bank. So their job is to focus on the rural area, right? So making banking more accessible to the countryside, and they are governed by the same rule as other bank, including the Banking Regulation Act and RBI Act. right? Then we have, let's talk about the private sector bank and foreign bank. You know private sector bank, so these are the banks that are run by private owner or company, and they are usually registered under the Companies Act. So they are registered under the section 3 of the Companies Act, and you know that these are the banks that are run by private owner or company. Then we have something called foreign bank. So these bank comes from outside India, but they follow Indian rule while operating here. So they come from outside India, they follow rules while operating here. These are called foreign bank, right? So they might be based in US, UK, another country, but they are regulated by the Banking Regulation Act and the RBI Act in India. And don't forget this cooperative bank. These banks are set up with the cooperative structure and have been around for a time. So dating back to the Cooperative Society Act of 1904. You can see it dates back to Cooperative Society Act of 1904. So they focus on helping member within the community, right? So there you have it, all the major types of bank in India and how they are formed. It is a mix of government owned, privately owned and community based institutions, all working together to provide banking service to different people in India. Now let's discuss some key points here. So friends, we are diving into cooperative bank and how they are structured and regulated. So friends, cooperative bank, what are they and how they are structured? In India, cooperative bank are of two types, right? Two main types based on their geographical reach and operation. So the first is called, urban cooperative bank, and this urban cooperative bank, they focus on cities and towns, and under it you can see a scheduled urban cooperative bank. You know what it is? So they are well regulated larger cooperative bank that are part of the scheduled list within the RBI. Then we have non-scheduled urban cooperative bank, which means these are a smaller one. So obviously let's talk about the key feature of the scheduled urban cooperative bank. So they are larger cooperative bank. They are larger cooperative bank and they are the part of the scheduled list. It's the name. And non-scheduled means what? They are smaller one, not listed with the RBI, but still offering essential banking service, right? So and then we have something called rural cooperative. You see rural cooperative. Let me show you. Here it is, rural cooperative. So these banks are all about supporting rural area. They focus on farmer and rural community. Then we have something called long-term cooperative. You know what is the meaning of long-term cooperative? So long-term cooperative, under rural cooperative there is a part called long-term cooperative. So it means these banks are designed to provide financial support for the long term. Like for example, I can tell you long-term cooperative, SCAIRBS, PCAIRBS. What is SCAIRBS? State Cooperative Bank. So short-term cooperative means you can think of them as the quicker helper in the time of need. We have DCCB. You might have heard of this term, DCCB. Let me show you. Just wait a minute. You might have heard of this term called DCCB, right? You can see some short terms are also there, like long-term cooperative. I told you, Descartes and Packards, and DCCB, District Central Cooperative Bank, right? So these are quick helper in the time of need. And we have PACS, which is Primary Agricultural Credit Society. They provide short-term credit to the local farmer. And then we have something called credit cooperative, right? So these are essentially lending cooperative that serve various community, urban and rural. So now the question is, how do this cooperative bank work under the law, right? So friends, what are the applicable legislation? The first legislation you can see is our Multi-State Cooperative Society Act, right? You can see written here, Multi-State Cooperative Society Act. So for cooperative bank operating in multiple states, this legislation is there. Name itself suggests multi-state. So those cooperative banks which are operating in more than one state, like for suppose Maharashtra, Karnataka or Andhra Pradesh. So suppose a bank is operating in more than one state, then this legislation is applicable. And there is something called State Cooperative Society Act. So this if a cooperative bank is only operating in one state, they follow the respective state law. But wait, how do cooperative banks fit into the larger banking system, right? So there are two types applicable legislation. Now the question is, how do cooperative bank fit into the larger banking system? So that is where the Banking Law Act 1965 comes into picture. So there is law which is called Banking Law Act 1965. So it comes into picture. It applied certain provision of the Banking Regulation Act. It applies certain provision of the RBI Act, right, to the cooperative bank. So these banks also have to follow some important banking rule, ensuring that they operate securely, right? So this is how cooperative bank fit into the larger banking system. Now there is a challenges in the cooperative bank. So basically what I am telling you, that there is a law which we call Banking Law Act 1965, right? So it applies certain provision of the Banking Regulation Act and RBI to the cooperative bank. So we can't say that only these acts, let me make you understand, that we can't say that only these acts like Multi-State Cooperative Society Act and so these are applicable to cooperative bank. But in addition to that, RBI Act and Banking Regulation Act are also applicable to a cooperative bank as per this Banking Law Act 1965, right? So that is called extension of the banking law. Now what are the challenges? Let's talk about the challenges, regulation challenges, right? Regulatory challenges of this cooperative bank. But not everything is smooth sailing, right? There have been regulatory challenges, regulation challenges, especially with the cooperative bank. One major example, is the PMC bank scam in Mumbai 2019-2020, where the bank failed and people lost their saving, right? You might have heard of it. So to tackle this issue, the Banking Regulation Amendment Act 2020, right? So this Amendment Act 2020 was introduced, giving the RBI more regulatory power, right, over cooperative bank to make sure they stay reliable and secure. So that is the lowdown on cooperative bank. They are a mix of urban and rural institution regulated by multiple law to keep things secure. And while there are challenges, new law are in place to improve their functioning. So let's talk about the key highlights of the RBI Act 1934. Just wait a minute. Yes, here you can see it. So friends, now you can see that are you ready to dive into the RBI Act 1934? It might sound like a lot of legal jargon, but I promise we are going to make this super simple and interesting. So the question is, why was the RBI Act of 1934 even created? This act was passed to set up the Reserve Bank of India. It was set up it was passed to set up the Reserve Bank of India, right? It came into force on 6 March 1934, and its primary aim was to regulate the issue of banknote. What was the aim of this RBI Act? Its primary aim was to set up the RBI Act. It was primary aim was to regulate the issue of banknote, right? The issue of banknote and keeping of reserve, right, and ensure that bank have enough reserve. Basically, it was created to make sure that India's money system work smoothly and stay stable. So what is the big goal of RBI? What is the big goal of this act? That to help achieve monetary stability in the country, securing monetary stability in India, right? Meaning controlling inflation, keeping the currency strong. So whenever I say this word monetary stability, it means we are keeping inflation under control. It means we are keeping currency strong. We are keeping our currency strong, right? And making sure that banking system does not go out of control. Now let's talk about the key highlights of the RBI Act. So now let's zoom into some key provision of this act that are super important for understand how RBI function. So the first is the constitution and power of RBI, right? So let's see here is the point, constitution and power of RBI. So the act lays down that how RBI is set up, its power and what it can do. It is like a blueprint. So this act is like a blueprint for how RBI operate, right? So there is a section called section number 42, right? So this one is about the cash reserve. So whenever you see this section number 42, remember it is regarding the cash reserve, right? So it says that all scheduled bank, right, we will get to know what is scheduled bank. It says that all scheduled bank must keep part of their money with the RBI, must keep part of their money with the RBI. This helps control how much money is floating around in the economy and keep things stable. Again I am repeating, section number 42 is all about the cash reserve. Means how much it means that a scheduled bank must keep part of their money with the RBI, right? So suppose this is the bank and this is the RBI. So it says that bank must park some of money with the RBI, that we call reserve, and this help control how much money is floating around in the economy and keep things stable. Then another section we have, you must remember the section name, it is section number 18. So this section allows the RBI to directly discount bill of exchange or promissory note to control credit when needed, usually during tough time. So RBI can engage into discounting of bill of exchange or promissory note when using during tough time, usually during tough time. Then we have something called the Central Board of Directors. Central Board of Directors. So the RBI is run by a Central Board of Directors, and that a governor and up to 4 deputy governor are appointed by the central government. So governor and up to 4 deputy governor, they are appointed by the central government. This is called Central Board of Directors. There are 4 directors nominated from the local board across India. 4 directors nominated by the central government from local board, and 10 other directors are nominated by the central government along with 2 government officials. 10 directors nominated by the central government and 2 government officials, right? So basically what we are talking about, that the Central Board of Directors of RBI, 4 directors, again I am repeating, first is the governor, right, governor and up to 4 deputy governor, 4 deputy governor, right? Governor, and then 4 deputy governor. They are appointed by the central government. They are appointed by the central government, right? And the 4 director who are nominated by the central government. 4 director nomination is also there, central government, and 10 director are also nominated by the central government along with 2 government official, right? So this is the constitution, this is the central board of director. Now let's talk about the scheduled bank definition. Just now we come to know about scheduled bank, what it means. See, a scheduled bank is one that is listed in the second schedule of the RBI Act. So those banks which are listed in the second schedule of the RBI Act, they are called scheduled bank, which means it follows the rules of the RBI and it meets a specific requirement. So if a bank is on the list of a scheduled bank, it is officially recognized by the RBI, right? If bank is on a list, it means it is officially recognized by the RBI. That's called a scheduled bank. Now important section to remember, let's discuss. So let's highlight a few important section. So section number 3, it talks about the incorporation of the RBI, that is establishment of the RBI. Section number 4 is talking about the capital about the RBI. Section 7, management of RBI. Section 22, you know, this is a huge, no need to remember all this. Section 22 is huge. It gives the RBI executive right to issue banknote. Only the RBI can print money. So I am talking only important section 3, 4, 7 and section number 22. Section 22 you must remember it, very important. And then the important one is section 42. I told you earlier that section 42 talks about the cash reserve that is scheduled bank need to keep with the RBI. And you know, section number 30, it is about the, it gives central government the power to overrule the RBI if needed. And you know, there is a term called lender of the last resort, which means what? And one of the most important role of RBI being the lender of last resort. In times of financial distress, when bank or financial institution are struggling and can't get help elsewhere, the RBI steps in to bail them out. This is to prevent the entire banking system from collapsing. So in a nutshell, we can say RBI Act is the backbone of Indian banking system. It is what keep everything running smoothly, ensuring that our money is in safe hand. So that is the part 1 lecture. So we will discuss the regulation and amendment in the next part. I hope you like the lecture. Please hit the like button. Please do subscribe our channel and share this video with your fellow bankers.